Starting now, Equity Mates, with thanks to our mates at Spaceship.
Welcome to another episode of Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Ready for another big Tuesday episode.
Yes.
As keen Equity Mates on AusBiz watchers would know, when we're sitting on a couch like this, all snuggled up,
Yes. Tight and cozy.
It means we've got a guest joining us, and we've got a great guest today.
Yes, one of the original OC guests of Equity Mates back in the day. It is our pleasure to welcome Michael Glennon from Glennon Capital to the show. Michael, welcome.
Thank you. Good to be here.
So today we're going to cover, Michael, with you a little bit about a margin of safety and then a couple of stocks that you have in your portfolio. So very much looking forward to cracking in. Let's start at the top. Margin of safety, it's something that you have spoken about. I've been following you for a while. My dad's been following you for even longer.
So no pressure.
So no pressure. Firstly, for those that have just started out on their investing journey, can you explain what margin of safety is?
Yeah, so I like to really try and simplify everything because you don't need to overcomplicate things. But the easiest way to think about, and there's a lot of different ways, it's making sure that you've got some sort of cushion when you're investing. So for argument's sake, and if you talk about GC1, the stock that we look at, you know, there's $1.05 of assets in there and it's trading at 75, 76 cents. So, you know, in the margin of safety for that is in the worst case scenario, you know, if the stock market closed, you have to give back all of the money, you're going to get back more money than what you put in there. The other way to look at margin of safety is we're looking at how conservative are your assumptions, and it's about what you're paying for a business. So you don't have to worry about, there's an accounting margin of safety about, you know, where a business will go broke, but in terms of that margin of safety when you're investing, you know, are you buying something that's, you might pay $1 for something, but you really think it's got $1.50 or $2.50 worth of value within that business? So we always try to make sure, you know, if you're paying $2 for $1.50 of value, I know it makes sounds weird, but if you look at a lot of tech companies, you really don't know what you're paying for in terms of assets if the business was wound up. So what's that level of safety you've sort of got around what you fundamentally believe the business is worth, so the intrinsic value of the business. So if you're paying $2, the intrinsic value is $1.50, you've got 50 cents that you could lose, so there is no margin of safety in that business. And that's the case that, you know, if you look at companies that lend out money, you know, like an Afterpay, it's always topical. If they had to close up shop, they've got a lot of debt that they lend out to people. What's the equity value of the business? You'll find that there's not a lot of margin of safety in the current price that you're paying for that business. So it's that surety about making sure you've got some cushion there to make sure that if everything goes wrong, have I got a buffer there? You know, that mean I've protected my capital if things do go wrong.
Yeah.
So when we're talking about the difference between the price you pay and intrinsic value, do you have a sort of rule of thumb of how much of like a margin of safety you want to see in the price that you're paying?
I tried to simplify it. It's a little bit more complicated than that because every different type of business, there's different factors that provide you with that margin of safety.
Yep.
So a couple of the stocks we're talking about later on, I'll talk about what the margin of safety for us is within that business, because there's no one valuation methodology that's right for every different type of business. You know, you'll have a breakup valuation on some businesses. Some other businesses you'll look at where they can go and what you think they're worth and what that's going to be worth to you today if the business stops growing and, for example, you might have a business losing money, for example. Doesn't look like it's got a big margin of safety, but it might be losing money because it's investing so much in future growth. Stop it. So that's the analysis part where you're going to work out where that margin of safety is by looking into the numbers and getting an idea of what's the actual business look like if business conditions change, really. That's the thing.
Does the way you think about margin of safety change between, I know you're sort of small cap manager, does it change if you're thinking about the large end of town, or is it a similar approach?
Oh, definitely, because I always say to people, small businesses are binary in the outcomes. Like the smaller the business, the more binary the outcome. So what that means is if you go back to sort of the basic, you know, decision trees, something will go, you've got a business and it's yes or no decision. No might mean that, you know, yes might be they win a big contract. it's all happy days, the business is profitable. No might be they don't win the contract, the business goes broke. The bigger the business, the more of those decisions there are and the less binary it is. So I just meant binary 1 or 0 is the outcome, 0 being going broke. The smaller the business, and there's a lot of very small businesses that don't make money, to put that binary context, binary outcomes in the context of small resource companies, there's a lot of exploration companies out there and it's completely binary. They find gold, copper, whatever it is, and the business is going to be successful if the grades and whatnot are right. If they don't, it's 0. And so that is a real example of those outcomes for smaller businesses. But as time goes on, you get more and more of those decisions. So it may not be, broke or not, just that division may do well. And, a lot of big businesses are, lots of small businesses put together. So there's a lot more margin of safety, for example, in a bigger business because one whole division can go broke and they've still got many others there. And you've seen many, many big companies make acquisitions. It's cost them, billions of dollars in some cases, and the business is still going today because they've got sufficient capital on the balance sheet and sufficient other revenue to support the business if something goes wrong. I have to worry less about that because we're doing the small things, trying to pick the next business that's going to be another big one.
So let's use that as the segue into two businesses that may be the next big one, and I guess use them as worked examples when we're talking about margin of safety. So first stock, Frontier Digital Ventures. Can you tell us a little bit about the company and then talk about how you think about margin of safety for this company?
That is the perfect segue. So really, that is the sort of investment thesis behind Frontier Digital Ventures. So what Frontier Digital Ventures is, it's a business. It's like a fund, and the fund has gone out and it's invested in 16 different businesses that operate in 21 different countries, predominantly developing countries, and owns a portfolio of online businesses. So the greatest, some of the greatest businesses I can tell you that have been successes over the last 20 years are online businesses in Australia. Realestate.com, Seek, tens of $1 billion valuations on those businesses, but started from very, very small business. I remember when Realestate.com had a $20 million market cap.
Wow.
I can't remember what year it was, but it was probably pre.
Did you invest?
Well, I've been in and out of it a couple of times, but one of my greatest regrets was, if you talk about being a young investor, looking at Realestate.com and always getting carried away and between what the PE was now, saying, I can never buy that. It's on a PE of 40, and where it could be. And I worked with a very smart guy a few years back who actually, and I thought, value investing was all about, it's got to have a single digit PE. But it may actually be that you might look at, and we used to talk about this when we invested in Afterpay very early. When it was $6 or $7, we had a valuation range of between 37 and 130, but there was no risk weighting on the 130. But it's being able to open your mind up and say, but if it becomes the next American Express, and that's how American Express was viewed as a bit dodgy back when it set up many, many years ago. But now it's a mainstream business that's got many, many arms. And I think the Afterpay people are very, very smart in what they do and how they've grown the business and where they've taken it. But does it look expensive now? Well, not if you take the view and you have conviction that it's going to get there and do all of those different things. So if you get back to looking at Frontier has these 16 different businesses that are all online businesses, and they're all in developing countries. So things like, real estate portals, car sales portals. And the beauty of it is within that portfolio, they can go and then give their expertise out to the companies to lend them the tech and the know-how and whatnot. And my personal view on this is that I've got 16 chances for them to get it right in one of those geographies, but one of them will be worth more, will be the next Seek or Realestate.com or another online business. The people behind it have got success, in doing that, setting up businesses like that. So they've got the experience, they can assess it better than I can, and I'm sure that one of those businesses will be sold out of that portfolio. It's got about a $500 million market cap. It will be sold out there for multiples of the current market cap. And if someone pays $2 billion for one of their businesses because it gets some success, that's multiples of where the share price is at now, but a fraction of where the well-established online businesses are. Yeah.
For a company like that, when you're making the decision to invest in Frontier, are you basing it on your, interpretation of how good the management are at making decisions to invest, or are you doing the work on the 16 companies as well to?
No, the first step is the management in that business, and I think that's the management in any company that you invest in. If you have no conviction in the management, it doesn't matter how good the product is, because management will destroy it by making dumb decisions. So the management there have all got form and experience. The major shareholders just sold out some shares. They've got successful online businesses before. The CEO was there in the early days of realestate.com. So they've got experience, they know what they're doing, they've done it before, they've got far greater ability than me. So I would pick one of those investments and put it in my portfolio. They're picking 16 and putting it into their portfolio. So that minimises the risk, but because they're running it as portfolio, they get the synergies and the benefit from being able to say, hey guys, look, I think you should go down this path here and that path there, because they've been there before, far more than fund manager giving their advice to CEO what they should do. You've got specialist people that understand that market, understand the products, and also understand the immense upside that will come if one of those products is successful.
So moving on to the second company to sort of illustrate the margin of safety concept.
Yes.
During the sell-off in March, you invested in a tech company, Class.
Correct.
For people who are unfamiliar with the stock, can you tell us a little bit about it, and then how you thought about margin of safety when making that investment?
Well, Class Super, if you're running a self-managed super fund, you might not be aware of it, but your accountant's probably using Class Super. So what it does, it'll log into different portals, and it saves accountants a huge amount of time in terms of administering self-managed super funds and reporting to their clients. So you may not know you've got it, but your accountant will definitely know that he's got it. It's such a valuable tool for accountants. The churn rate is incredibly low, like it's in the single digits. But it's mature. There's not a lot of growth in it. But if you look at that business, we think that probably about 80% of the share price is the value just of the Class Super product. So it's got 2 new products in there though that they can market to the same client base. So you're virtually paying next to nothing for those products that we think can be 2 to 3 times bigger. It's if you the accountant's already using it, for him to do an add-on and sell that into his client or start to use the additional product, you've already got virtually 100% of your clients will probably take that product up, and it's being valued at nothing. I think it can be multiples and multiples bigger. So where the margin of safety sits within that is that you've got the potential for, basically you've got an annuity stream valued about $1.10 a share, and then you're paying 40 cents for the other 2 businesses that are worth, at least in my view, over time. In the most conservative case, talking about margin of safety, one of them will be as successful, and that's another $1.10 a share. But this is over several years for them to get that market share. But it's growing. They're getting traction. They've got low churn rate. They've got good management. It's a good product. You talk to accountants, they can't live without it. It's a bit of a no-brainer, and it's just not that sexy for the market. So it's languished a little bit, but we're happy with the investment. I think that gives us margin of safety, lets me sleep at night knowing that it's going to continue growing. They're going to continue getting revenue. I don't have to worry, and I can say to you confidently that business will be bigger in 3 months' time, 12 months' time, and 18 months' time.
When you're doing your modelling, how are you factoring in or thinking about the current interest rate environment, and how does that impact margin of safety, and with interest rates essentially zero?
Yeah, I'm not sure how sophisticated the audience is in terms of things with discount rates and when you have a very low interest rate, the impact that has on valuations. But to sum it up, and I hope you guys don't get criticised for my oversimplification, but your discount rate with very low interest rates is very low, which means that the valuation becomes very high, so you get asset price bubbles and things like that when you've got low interest rates. So if you look further forward, you're going to get some contraction of asset prices, right, and multiples that things trade on. Do I worry about it overly? No, because we never discounted them that far back anyway. We left them relatively unchanged. It wasn't a lazy thing. It's more of what's the fair cost of capital. So put that into your model and say, well, that's what I think this is worth, but we are an asset price bubble. But ignoring all of that, what am I prepared to pay for a business that I think, the joy of small caps is you want to be buying businesses that are either really cheap as a value situation, or growing, and they're going to
Yeah.
grow in any market condition, like
Yeah.
a class super. So, FDV did have some issues through COVID because it's in developing countries. A lot of people couldn't work, had no income, and so a lot of the revenue, a lot of those businesses went backwards, but they are developing. And the thing about developing countries, you generally get stronger growth rates in developing countries than you do in more established countries. I mean, Australia has a very low GDP growth rate. You don't have the same thing in places like Vietnam and North Africa and places like that, because people are putting money in there. They've got cheap labour and people exploit that. Big companies go there and they grow. So that gives us comfort on that side of the business, that regardless of what happens with discount rates, businesses will still be growing and different economies will grow at different rates.
Yeah. So, Michael, you for those watching at home, you do have a listed fund, and is
We
it
do.
GC1?
GC1 is
Yep.
the ticker code, yeah.
That's the ticker code. So, for those listening at home, if you're enjoying what Michael's saying, you can check it out on the ASX. GC1 is the ticker. But that is all we have time for today. Thank you for coming on.
Thanks, guys.
We can unpack a lot more, but we'll have to get you on the podcast, I think, to
Thank you.
to go in further detail. But that is all we have time for today on Equity Mates. Stick around for tomorrow because it is Watchlist Wednesday.
That's right. We've got Julia Lee from Berman Invest joining us to talk about 3 stocks on her watch list. So see you there, same time, same place. But until then, thanks for watching.
See you then.
Equity Mates, with thanks to our mates at Spaceship.